Guys, have you ever wondered why some lenders can do some loans and other lenders can do other loans and they go to this company and they say that they're not qualified? Largely, it is because that mortgage company, whether it's a big bank, small bank, broker, whatever, has what are called overlays to the conventional FHA, VA, USDA guidelines. So it is important when you're working with a lender, or if you're a listing agent and you have a pre-qual letter, it is important to ask the loan officer, does your mortgage company have overlays to the Fannie and Freddie guidelines? What overlays are, they're basically rules on top of rules. So my prior mortgage company that I was at, no, it was not a big retail bank. It was a company like I'm at now. The CEO had a very conservative approach. For example, they would not allow us write FHA loans under 600, even though technically FHA loans can go down to 500. And that's because they had rules on top of Fannie and Freddie's guidelines. These are what are called MRI books. These are basically the guidelines, which change constantly, that mortgage lenders abide by. That things like, okay, can you use second income? If somebody has a car allowance, how long does that car allowance have to be there in order for us to use it in their income? Things like child support, things like self-employed guidelines. These are the guidelines that are written directly from Fannie Mae, Freddie Mac for the conventional FHA, VA, USDA rules. We are a mortgage company that underwrites directly to those rules. So when in doubt, if you have a client that got disqualified or declined, please let myself and the team take a second look at it. Doesn't necessarily mean that we can be the hero and save the deal, but oftentimes we find out that that mortgage company has a rule, and that's why they're saying they're not qualified, even though they could with another lender, or the loan officer just didn't ask enough probing questions. So last week we just closed the loan. The client was denied by three other mortgage companies, not a retail bank. These are three normal mortgage companies. And it's because the loan officer didn't find out that the married couple today, when they actually got married, because there was some debt on one of the spouse's credits that was prior to them getting married. And there's a loophole in the FHA guidelines that allows us to ignore that debt. But had we not asked the question, because we were trying to figure out how to get them qualified, then they wouldn't have been able to buy the house. And so a lot of loan officers just use technology. They go online, they fill out the application, and the loan officer isn't asking questions. Sometimes that's because the loan officer doesn't have the bandwidth. If you're dealing with a loan officer that doesn't have an assistant or doesn't have any kind of help, I hate to say it, but it's likely they don't have the bandwidth to see if they can help with their credit or research the guidelines to see if they're missing something or call the client and ask probing questions. They just don't have the bandwidth. We have a 6-person team that specializes in credit, specializes in self-employed, specializes in first-time homebuyers, specializes in jumbo loans. It is important to have those specialists and enough people to give your client the bandwidth and really the service that they need to make sure we've exhausted